to Staffworks Explain. If you're here for the first time, please consider subscribing to this channel. In this video, we'll be talking about Kenya Airways dream or aspiration to invest in 100 aircraft, where we say it's a bold vision and some are saying it's a high attitude gamble. We'll look at the growth aspiration as well as economics behind the Kenya Airways biggest fleet expansion. Every successful airline tells two stories. The first is written in aircraft orders, new routes, and passengers growth. It is the story of passengers the story that passengers see. Modern cabins, expanding destinations, as well as large fleets connecting continents. The second story is far less visible. It unfolds inside boardrooms, financing negotiations, maintenance hangars, as well as airport master plans. It is the story measured on not in aircraft deliveries but in balance sheet, debt servicing, operational efficiencies, as well as execution discipline. Kenya Airways' latest announcement belongs to both narratives. The national carrier plans to expand its fleet from approximately 32 aircraft today to 67 by 2030 and eventually 100 aircraft by 2035. This is one of the most ambitious aviation strategies announced in Africa in recent years. The airline expects passenger traffic to rise from roughly 5.2 million annually to about 9 million by 2030, positioning Nairobi as one of Africa's leading aviation gateways. The company executives unveiled the vision during the Kenya Travel Agents Engagement and Awards in Nairobi, describing it as a long-term strategy to rebuild the airline's competitiveness and expand its international footprint. The announcement immediately attracted attention across the aviation industry. On paper, the aspiration is compelling. A large fleet allows the airline to open new routes, increase frequencies on profitable destinations, improve aircraft availability, and capture growing passenger demand across Africa, Europe, Asia, and Middle East. Yet aviation history offers an uncomfortable lesson. Growing an airline is relatively easy. Growing profitability is extraordinarily difficult. For Kenya Airways, that distinction matters more than the deadline figure of 100 aircraft. The numbers inspire confidence, but they also invite scrutiny. Kenya Airways has spent much of the past decade navigating financial turbulence. After recording its first pre-tax profit in more than a decade during the 2024 financial year, the airline slipped back into significant losses in 2025, largely because several Boeing 787 Dreamliners were grounded amid global supply chain constraints, reducing available capacity and revenue. Reuters reported that the disruption exposed how dependent airline profitability has become on maintenance, logistics, as well as availability of aircraft rather than passenger demand alone. That experience illustrates why fleet expansion cannot be viewed simply as an exercise in acquiring more aircraft. Every additional aircraft introduces financial obligations. Aircraft require financing, insurance, maintenance reserves, trained crews, spare engines, simulator capacity, ground support equipment, and airport infrastructure. Revenue only materializes if those aircraft consistently fly profitable schedules with sustainable passenger demand. This is where Kenya Airways faces its first strategic challenge. The airline is not expanding from a position of overwhelming financial strength, similar to Emirates or Qatar Airways. Instead, it is attempting to accelerate growth while continuing its financial recovery. That does not make expansion impossible. It makes disciplined execution indispensable. Bigger does not always mean strong. The aviation industry has repeatedly demonstrated that fleet size alone is an unreliable measure of success. Several airlines have expanded aggressively only to discover that aircraft generate costs just as quickly as they generate revenue. Fleet growth must therefore remain closely aligned with market demand. If aircraft arrive faster than passengers' growth, utilization declines. If utilization declines, operating costs rise. If costs rise faster than revenue, profitability deteriorates. These relationships appear deceptively simple, yet they remain among the principal reasons why airline expansion strategies fail. Kenya Airways therefore faces a balancing act. Growing too slowly risks surrendering market share to competitors. Growing too quickly risks repeating mistakes that have challenged numerous airlines worldwide. Ethiopia Airlines offers both inspiration and caution. Comparison with Ethiopia Airlines are inevitable. Both carriers occupy strategically important geographic positions. Both rely heavily on hub and spoke operations that connect African passengers with Europe, Asia, and Americas. Both compete for transit traffic crossing the continent, yet similarities end there. Ethiopian Airlines has spent decades pursuing disciplined expansion supported by consistent profitability, strong cargo operations, extensive maintenance capability, and a long-term government-backed aviation strategy. Its proposed Bishoftu International Airport, estimated to cost approximately 12.5 billion US dollars, reflects infrastructure planning that seeks to match future airline growth with airport capacity. Kenya Airways is pursuing similar destination but from a different starting point. Rather than consolidating decades of interrupted expansion, it is rebuilding after years of restructuring, debt constraints, as well as operational disruption. That difference should shape expectation. A target of 100 aircraft is entirely achievable over a decade. The more important question is whether every aircraft added strengthens the business. Fleet growth cannot outpace infrastructure. Perhaps the least discussed aspect of Kenya Airways strategies lies beyond the airline itself. Aircraft require airports capable of supporting them. Jomo Kenyatta International Airport has long served as Kenya's principal aviation gateway, but its infrastructure has struggled to keep pace with rising passenger numbers. Successive governments have proposed expansion programs, including additional terminal capacity, runway improvement, and broader modernization initiatives aimed at transforming JKA into a competitive regional hub. More recently, Kenya approved renewed investment plans to expand the airport's capacity, reflecting recognition that Nairobi aviation infrastructure must evolve alongside airline growth. This relationship between airline strategy and airline infrastructure or airport infrastructure is often underestimated. Airlines do not operate in isolation. Runway capacity determines aircraft movement. Terminal capacity influences passenger experience. Cargo facilities affect freight growth. Maintenance hangars influence fleet reliability. Digital infrastructure shapes operational efficiency. Expanding one component while neglecting the other creates bottlenecks that ultimately constrain growth. From a program management perspective, Kenya Airways fleet strategy and JKIA modernization should therefore be viewed as interconnected projects rather than independent initiatives. If one advances substantially faster than the other, operational efficiency inevitably suffers. Financing the vision, let's look at that. Perhaps the most critical question concerns funding. Aircraft are among the most expensive commercial assets in the world. Industry estimates suggest that achieving Kenya Airways long-term expansion could require between 1.5 billion to 2 billion US dollars in new investment, much of it expected to come from strategic investors, leasing arrangements, and alternative financing mechanisms rather than outright purchases. Company officials have indicated that discussions with potential investors have progressed to due diligence while emphasizing adherence to corporate governance standards. That approach reflects changing realities across global aviation. Leasing has become increasingly attractive because it reduces upfront capital requirements while allowing airlines greater flexibility to adjust fleet composition as market conditions evolve. However, leasing transfers rather than eliminates financial obligations. Monthly lease payments continue regardless of passenger demand. Consequently, route planning becomes even more critical. Every aircraft must consistently generate sufficient revenue to justify its place within the fleet. For Kenya Airways, this means expansion cannot be simply measured by deliveries. It must be measured by profitable deployment, and that is a considerably more demanding benchmark. Building capacity is easier than building resilience. When we talk about fleet expansion, it is often interpreted as a measure of aspiration. In reality, it is a test of institutional capacity. For Kenya Airways, increasing the fleet to 100 aircraft will require far more than acquiring additional jets. It demands proportional expansion of every operational function that supports an airline. Pilots, engineers, dispatchers, cabin crew, safety inspectors, maintenance planners, revenue managers, digital systems which must allow growth at a pace that keeps the airline stable rather than overstretched. The aviation industry refers to these as scalable operations, the ability to increase output without compromising safety, efficiency, as well as service quality. That principle has become increasingly important as airlines contend with persistent shortages of skilled personnel, among other problems. Boeing commercial market outlook projects that the global aviation sector will require hundreds of thousands of new pilots, technicians, cabin crews, over, I mean, as well as others over the next 2 decades. The competition for experienced aviation professionals is therefore no longer regional; it is global. For Kenya Airways, retaining skilled employees may become just as important as recruiting them. Expanding the fleet without securing sufficient technical expertise would increase operational risk and place additional constraint on existing staff and potentially affecting schedule reliability. Supply chain remains aviation's weakest link. The pandemic exposed structural vulnerability that continue to affect airlines years after. Aircraft manufacturers are still dealing with production bottlenecks. Engine manufacturers continue to face component shortages. Maintenance providers report extended turnaround times for major overhauls, while airlines across the world have struggled to obtain spare parts quickly enough to maintain planned schedules. Kenya Airways has already experienced these constraints firsthand. The grounding of part of its Boeing 787 fleet because of engine maintenance delays demonstrated that even a well-managed airline can see carefully prepared schedules disrupted by events beyond its control. Expanding the fleet in such an environment requires careful sequencing. Aircraft deliveries must be synchronized with maintenance capacity, spare parts availability, as well as crew readiness. Otherwise, the airline risks increasing the number of aircraft on its balance sheet without achieving a corresponding increase in operational capacity. This is where programs integration becomes essential. Every work stream, procurement, maintenance, operations, finance, as well as human resources, must progress in coordination rather than independently. Failure in one area can delay benefits across entire program. Now looking at the competitive landscape, which we say is becoming more demanding. Kenya Airways is pursuing expansion at a time when competition for African air traffic is intensifying. Ethiopian Airlines continues to strengthen its position through fleet modernization, an extensive route network, as well as investment in airport infrastructure. Rwandair, although considerably smaller, has steadily expanded its regional presence with leveraging Kigali's location as a growing transit hub. Air Tanzania has sought to rebuild its fleet with government support while establishing international carriers, including Emirates, Qatar Airways, Turkish Airlines, which continue to capture a significant share of long-haul traffic connecting Africa to the rest of the world. Competition is no longer defined solely by aircraft numbers. Passengers increasingly compare airlines based on schedule reliability, connection times, digital services, loyalty programs, onboard experience, as well as network connectivity. Cargo operators evaluate logistics efficiency, custom processes, as well as turnaround times before selecting preferred hubs. This changes the strategic equation for Kenya Airways. The airline objectives should not simply be to match competitors in fleet size, but to outperform them in operational consistency as well as customer value. A smaller, efficiently deployed fleet can generate stronger financial returns than large fleets constrained by low utilization or network inefficiencies. JKI will determine whether that strategy succeeds. No airline can develop into a major intercontinental hub without a corresponding investment in airport infrastructure. Jomo Kenyatta International Airport therefore occupies a central place in Kenya Airways' long-term strategy, even if it is often discussed separately. Over the years, JKI has faced recurring challenges associated with congestion, aging facilities, as well as increasingly demand. Expansion proposals, including terminal modernization, improved airside infrastructure, as well as enhanced cargo facilities, have reflected a broader recognition that Nairobi Gateway must evolve if it is to compete effectively with emerging hubs elsewhere in Africa. The relation between the JKI and Kenya Airways is symbiotic. A larger fleet requires additional parking stands, more efficient aircraft movements, expanded maintenance facility, greater baggage handling capacity, and improved passenger processing systems. Equally, investment in airport infrastructure yield greater economic returns when supported by airline capable of generating sustainable traffic growth. This alignment extends beyond aviation. An efficient airport stimulates tourism, attracts multinational investment, strengthens exports, supports conference tourism, and enhances Kenya's position within regional supply chains. However, coordination is critical. If fleet expansion significantly outpaces airport modernization, congestion could reduce operational efficiency and increase cost. Conversely, expanding airport infrastructure without corresponding airline growth risks underutilized assets and delayed returns on investment. Synchronizing both programs should therefore be viewed as a national strategic priority rather than as separate institutional objectives. Governance will shape investor confidence. Financing an expansion of this magnitude depends as much as on confidence as it does on capital. Potential investors and leasing partners assess more than financial statements. They examine governance structures, procurement transparency, regulatory stability and management credibility before committing long-term resources. Kenya Airways has made notable progress in strengthening corporate governance following years of restructuring and financial reforms. Even so, sustaining investor confidence will require consistent decision-making, disciplined financial management, as well as clear communication of strategic priorities. The airline's leadership will also need to resist the temptation to equate growth with success. Effective governance means maintaining the flexibility to adjust expansion plans if market conditions change. Aviation is inherently cyclical. Fuel prices fluctuate, exchange rates shift, geopolitical tensions alter travel patterns, as well as economic downturns after passenger demand with little warning. This affects demand, and there is little warning. As a resilient strategy is therefore one that allows recalibration without undermining the long-term vision. Sustainability is becoming a competitive requirement in the aviation industry. Environmental performance is increasingly influencing aviation investment decisions. International regulators, financial institutions, and aircraft manufacturers are placing greater emphasis on fuel efficiency, emissions reduction, as well as sustainable aviation fuels. Airlines that modernize their fleet with newer generation aircraft can reduce fuel consumption while lowering maintenance costs and improving operational reliability. For Kenya Airways, fleet renewal should therefore be viewed not only as a commercial strategy, but also as an environmental and financial one. Operating modern aircraft enhances competitiveness in multiple ways. It improves customer perceptions, reduces operating costs, and aligns the airline with evolving global sustainability expectations. These factors are likely to become increasingly important as investors incorporate environmental, social, and governance (ESG) consideration into financing decisions. Now we say that a vision is worth pursuing, but this one demands discipline. Kenya Airways' aspiration to operate 100 aircraft by 2035 is neither unrealistic nor unprecedented. Other global carriers have transformed themselves through sustained, carefully managed expansion. The difference has never been the scale of ambition, it has been the quality of execution. The airline is entering a decisive period in its history. It has regained operational momentum, restored confidence among many stakeholders, as well as articulated a vision that aligns with Kenya's broader economic aspirations. Yet, aspirations alone cannot overcome structural weaknesses. The next decade will test whether Kenya Airways can integrate fleet planning with airport modernization, financial sustainability, workforce development, as well as operational excellence. Success will require disciplined governance, prudent financing, and a willingness to prioritize profitability over symbolic growth. If these elements remain aligned, a fleet of 100 aircraft could redefine Nairobi's role within global aviation and strengthen Kenya's position as South Africa's leading commercial gateway. If they do not, the number itself will become little more than a headline, impressive in announcement, but far less significant in practice. Ultimately, the measure of success will not be counted in aircraft parked on the apron. It will be reflected in an airline capable of generating consistent profits, sustaining investor confidence, delivering reliable service, and supporting Kenya's broader economic transformation. In aviation, the most enduring legacies are rarely built by those who grow the fastest, but by those who expand with purpose, precision, and the discipline to ensure that every new aircraft contributes to a stronger enterprise rather than a larger one. So thank you for coming this far. If you are here for the first time, please consider subscribing to this channel. You can watch other videos that I have made on aviation industry as well as in other projects across Africa. So thank you, and let's meet in the next one.